Hi, Paul Benedict here with the Benedict Group at Keller Williams Realty Las Vegas. I'm honored to be joined today by Neal Katz, a mortgage lender with All Western Mortgage, and Sheila Rhinehart, a tax professional with Rhinehart & Associates, both based right here in Las Vegas. Today we're going to have a conversation about filing tax returns for tip earners and 1099 independent contractors, both of which comprise a large percentage of our workforce here in the entertainment capital of the world. Specifically speaking, on many occasions, Neal and I consult with first-time home buyers who have the idea that writing off as much as possible on their taxes, therefore paying as little in taxes as possible, is the right financial move for themselves and their family, when in fact that strategy usually bars them from buying a home. So that's the topic we're here to discuss today. You guys ready?
Sure. Yes.
Awesome. First, I'd like to welcome both of you. Thank you for joining me.
Thank you,
Thank
Paul.
you.
Neal, I'd like to give our viewers an overview of how a mortgage lender looks at a borrower's income during the approval process. And so tell us what a debt-to-income ratio is and how it's calculated.
Okay. Well, a debt-to-income ratio is how much of a borrower's income is eaten up by debt. So how we calculate it is we take their monthly debt and we divide it by their monthly income. Pretty simple, straightforward. What affects that number most of the time, besides a lot of debt, is how much income are they declaring, which I'm sure we're going to go over very soon.
Awesome. And what is an approximate debt-to-income ratio that lenders look for to approve a borrower?
Safely 50%. So if
Okay.
if their income is, let's say we determine it to be $3,000 a month, all of their expenses, including their house payment, cannot exceed $1,500 a month.
So all the debt, including their new house payment that they're looking for, can't exceed half of their total gross monthly income.
Correct. There are times when we can go to 55% and even higher, but I would say 50 is a solid number to use.
Now the question becomes, what number is the income? Tax returns are very complicated. So where on a borrower's tax return can they look to find the number that's used, that's divided by 12, like we said?
Okay. Traditionally, and we are speaking of tip earners and self-employed borrowers.
1099.
1099. So they typically file a Schedule C for their income, and we as lenders are typically looking at the bottom of Schedule C. That is the number that we're going to look at. So the top has what they've grossed, the middle has all the deductions that they're going to take, and the bottom is the number we're going to use.
Awesome. The bottom of Schedule C.
Correct.
Do you concur, Sheila?
I would agree. That would be the net of what a self-employed person is declaring.
And that's the number that a lender will look at to determine their income, which once divided by half is the amount of debt they can have to qualify for a home.
We are assuming there's no other income coming into the home.
Correct. That's the key point.
Yes.
And of course, these sample scenarios and these discussions are very general. Every human being, how many humans are there? 7 billion on the planet? So there might be 7 billion different scenarios,
yeah.
right? Sheila, I'd like to turn to you now.
Sure.
Speaking of write-offs, since you prepare tax returns, when a customer comes to you and says, Sheila, I want to write off everything and I want to pay next to nothing in income tax, is there a way ethically for you to explain that they have to show some income and pay some taxes on that income in order to buy a house?
Well, that is actually a good question, because what happens is I, as the tax preparer, am able to claim all the expenses that are legitimate and legal. So if they end up claiming a loss, I can do that. I do explain to them that they have to be able to justify and show those expenses if they're ever audited. But I don't have an ethical concern about whether they're not claiming enough revenue or not. So where this question comes in is, all right, if we're claiming X dollars of revenue and it ends up being a loss, and then they say, well, I can support a house, then where was this other revenue that they weren't claiming beforehand? Because the mortgage lender is going to look at their tax return and say, well, you're either not claiming enough revenue or you're claiming too many expenses. And that's the real question, not on the tax return. Like I said, as long as it's legal and it's legitimate, then I can put those expenses against their revenue, and as long as they're claiming all their revenue.
So every time you meet with a person who's going to file their taxes, invite Neal or myself to sit in on the meeting. And we,
It's like another full-time job.
Right.
Do you find that many of your customers are curious about qualifying for a home? I mean, I know it's not in the realm of your industry, but talking about income and finances, does that question ever come up when the idea of writing off taxes is brought up? Does the idea of qualifying for a home get brought up as well?
A couple times. Most of the time, it's the first question which you already asked me, which is, how can I pay the lowest amount of taxes possible? And just an interesting fact is that if you've got a person making $55,000, whether they're self-employed or they're a W-2 earner, the only difference between the actual taxes paid is $3,900. So a self-employed individual pays $3,900 more than the W-2 earner. It's just the W-2 earner doesn't see all those taxes come out because they get taken out of their paychecks before they get their money.
So it's like a forced tax payment plan. Interesting. Let's turn back to you, Neal, and I want to talk about a specific example with real-time numbers applying to the Las Vegas real estate market today. So the median price of a home today in Vegas of a detached single-family house is $305,000. So if the borrower puts 5% down, and if the interest rate is 4.25%, which they are approximately today, or is that
Probably even better, but we'll use that as a
Okay, so that's a conservative estimate, 4.25%.
Correct.
The payment is approximately $1,855 a month for principal, interest, taxes, insurance, without any HOA payment. Now, you said earlier that we have to include all of the customer's debt when calculating the ratio. So they're probably going to have a car payment. So if we take the $1,855 potential new house payment, I Googled the average car payment in America, and CNBC says it's $456 a month. So let's add $1,855 for the mortgage to the $456 car payment. That's $2,311 a month.
Okay.
If that's their debt, assuming they have no credit card bills, no student loans, no medical bills, no other debt, what does their income need to be to afford a home with $2,311 a month in debt?
Well, the fast answer would be just double the debt.
Okay.
So it'd be $4,622.
Exactly.
$4,622 a month, which multiply times 12, and that comes out to be about 50-something thousand a year, 55,000 a year.
Okay.
However, based on their credit score, we don't know how much we have to add to their house payment for mortgage insurance.
Okay.
And so, again, the higher the credit score, the lower the mortgage insurance. So I'm going to say the short answer is $55,000. The long answer is probably between $55,000 and $60,000 a year.
Interesting. Very good. Now, Sheila, if someone is claiming $55,000 a year of annual income, I know this is probably a very tough question to ask, but what would their tax liability be on that? How much taxes would they pay if they're showing $55,000 a year?
So actually, it's on the piece of paper I don't have.
Rough estimate.
Rough estimate is, as a W-2 earner, you're talking a net $7,000 in income taxes, but as a self-employed person, you're looking at about $20,000 because you're paying your taxes and then your Social Security and your Medicare taxes all on that tax return. So it just looks like a bigger number, but the difference is really $3,900.
Okay, so digging a little bit deeper into that,
Yeah.
if someone was an employee that received
Yes.
a W-2 and their income was $55,000, they would still be paying almost the exact same amount, like you said, with a several $1,000 variance, but they wouldn't feel like it's writing a check for 20
Correct.
grand at the end of the year.
Right.
Okay. So it's almost the same thing.
Yeah.
People that are 1099 or tip earners, they need to plan their taxes.
Correct.
And that's part of what you do, yes? You
Yes,
help
it
them
is.
plan their taxes.
Absolutely. So the tax planning aspect of it is, here's how much you're making on a quarterly basis, and this is how much tax you should be paying every quarter, because the tax system is a pay-as-you-go. That's what makes it so nice for your W-2 earner, because the taxes are taken out every single paycheck. Whereas a self-employed person has to be disciplined to put that money in a separate bank account and pay in once a quarter. Now, they can pay in more often, but typically they don't want to. They'll just pay in once a quarter.
Once a quarter. So that eliminates the need to come to the end of the year and come to Neal or myself and say, hey, I want to buy a house. Oh, I need to pay some taxes on the income I earned. Write a check for 20 grand. That's challenging for people. So
Correct.
planning properly for taxes lessens the burden at the end of the year of writing a big check like that, would you say? So people need to come and visit with you for some tax planning sessions.
Yes.
Good advice.
Awesome. All right, Sheila, again, so if someone wants to buy a home and they're talking with Neal and myself, and they submit their tax return and it shows an annual gross income of, say, $12,000, but they say, $12,000, I made 85 grand last year. And then Neal and I would say, well, it's not on your tax return. They say, oh, I wrote it all off because I didn't want to pay taxes. And then we say, well, unfortunately, you're not going to be able to qualify for a home until you file your next year tax returns. And they say, well, I want to buy a home now. So my question is to you, Sheila, is there a way to go back to last year's tax return and amend it?
Absolutely. So the IRS has no complaints about an individual going back, changing a tax return and saying, hey, I want to pay more taxes.
Okay, well, that's a good thing.
The IRS is perfectly willing to accept that. If somebody's pre-planning and they think, oh, how about I show a net of $55,000, $60,000, and then in a couple years after I've got the house I want to amend, then now we're claiming more expenses. Unfortunately, that creates a situation where the IRS may request additional documentation to support those additional expenses.
So the risk of audit goes significantly
Yes, it does.
higher. Okay, so it is possible and probable to be able to amend a tax return to show more income, thus paying more taxes.
Right.
That's an easier avenue than the other way around, reducing your income and getting a credit back, for example.
Yes.
Okay.
Yes.
So it is possible that someone would clearly have to have the money to pay their tax liability. And Neal, back to you now. So if this person does this, so if the borrower comes to us, they showed 15,000, but they really made 85, so they go to Sheila. Sheila helps them amend their tax return, and then they do that. They come back to us and say, I'm ready to buy a house now. They send you their revised tax return. Is that going to work for your underwriter?
That's a good question. The answer is yes.
Okay.
It will. As long as they are, the correct term is as long as they're not in application. But for us, as long as they're not in contract. Once they're in contract,
To buy a home, you mean?
to buy a
Okay.
home,
All right.
the underwriter would not accept any amended tax returns.
Okay.
So-
But if they're amended prior to the home search process beginning?
Correct, yes.
Okay.
However, when somebody starts to declare more income, which is perfectly allowed and the IRS enjoys those
Yes.
moments, they now have to pay those taxes, and there's only one of two ways to pay them. Either write the IRS a check for the entire amount, and let's just say it's $11,000. I don't know why that number came out.
Okay.
Most people can't do it. So now what they have to do is they have to enter into a payment arrangement with the IRS. And that has to be prior to being in contract.
And the payment is now included in the borrower's
Correct.
debt to
Yeah,
income
so
ratio.
it gets thick, or it gets a little dicier. But I've done it, and it works. They just have to be in that agreement with the IRS for, we say 3 months, but it can be done less. You make that first payment, and 2-3 weeks later you make that second payment, and then 2-3 weeks later you make that third payment, and we're fine with that. But we want to see 3 payments made, and they can't be made together. But you know, if you spread it out over a course of a month to a month and a half,
So it's possible.
Yeah, 100% possible.
What I'm hearing is that buying a home is very realistic, except it's complicated, and it seems to be getting more complicated as we dive into these details. So what I want our viewers to understand is, come talk to us prior to filing your tax return and prior to starting the home search on Zillow or Trulia or any of the consumer-based real estate search engines. Come talk to us and understand how to best structure your finances so you can qualify for a home. The links for Neal Katz at All Western Mortgage and Sheila Rhinehart with Rhinehart & Associates are below in the comments section of the video. I want to turn back to you two and ask if there's anything else you'd like to add in the effort to educate first-time home buyers on buying their first house and structuring their finances properly. Any last thoughts?
Well, I definitely recommend the planning aspect of it. Even if you're a W-2 employee, this last year, due to changes within the withholding tables, a lot of people owed where they hadn't owed before. And so adjusting those W-2s so that you've got enough taxes withheld is crucial, especially if you're looking at that installment plan agreement being included in your debt ratio. So I definitely recommend some tax planning, a good year or two before you really step out and make a good home purchase.
Thank you so much.
good information.
And thank you for watching. We'll be back next time with more juicy info on home buying. Thanks for being with us.